If there's one thing I want you to leave with from this video today, it's this. Risk management is a process, and there's analytical and detailed steps you can take to manage risk in your portfolio and all other investments. In case you're new here, hi, I'm Mark Anderson. I run a zero DT hedge fund, which has sold over $50 million in zero DT premium, and I've had profitable quarter returns for each of the last 20 consecutive quarters. I take risk management very seriously. If you don't have an actual risk management process, then I can practically promise you that your perceived risk is likely very different than your actual risk. Welcome everyone, live here at Just Press Record, Austin, Texas. Today we'll be speaking about risk management and hedging. I think we all have at some point been on a plane and prayed or seen someone else saying a short prayer right before we take off. But statistically speaking, you are 1,000 times more likely to die in a car accident on your way to the airport than on the flight itself. But you don't see people praying before each time they get into a car now, do we? Even though statistically, that's when we'd want to send those prayers. And that misconception between risk awareness and risk reality is exactly why every investor needs to know how to be a risk manager first and a resource allocator second. We've already had numerous unprecedented events and catastrophic events in the market during the following 5 years. The COVID crash of 2020, when the market sold off 34% in under a month. In 2022, when we had the largest decline in the 60-40 bond stock portfolio since 2008, hitting an 8 to 9% inflation rate, and a seemingly unnoticed multi-trillion dollar unwinding of the yen carry trade earlier this year, causing the largest volatility expansion in the history of the VIX index. After experiencing these events, I've learned and applied and adapted my approach to manage risk. The first wave of these events practically brought me to my knees, and since then, I have to tell you that proper risk management is both empowering and stress relieving, to say the least, because life does happen. And here's just one example. Now, you might be expecting that I'd tell you about a dramatic drop due to COVID and the shutdowns. This story actually starts in 2021 because I was working in construction when we were deemed essential. So I was still going into work each day. I was building hospitals in San Francisco. My salary was 150 grand. I was secure. I had 180 grand in tax deferred accounts, 250 grand in my savings, along with 8 cash flowing rental units with an oh so low 2.5% interest rate and near 800 grand in equity in those homes. With all the rentals and trading options, I was bringing in close to 15 grand a month in passive income. I was on top of the world. I did all the right things. I was ready to be financially free, to reap the benefits from all the hard work and wise moves that I had made. And my plan was to start a hedge fund so I could help others achieve financial freedom. I was so sure of my stable situation that I turned down a job paying even more, close to 200 grand during that time. Fast forward to 2022, Russia invades Ukraine, CPI reaches 8%, and mass layoffs spread throughout the job market, including my position in construction. That sucked, but it still wasn't a huge problem because all I needed to do was get my refi out of that near 800 grand in real estate and access those funds tax-free. Well, the refi fell through. Why? Because the bank looked at as unlendable debt to income ratio. They refused to take in consideration the rent from the properties and that I had roommates in San Francisco that were basically paying a portion of the mortgage as well as the tenants to lower my debt to income ratio. I was stuck. Then the market dropped and my stock portfolio took a 20% hit of my core holdings of the S&P in the market. On top of that, I had to evict a tenant, which of course was a lengthy and expensive process. And by that time, they had finally left. I discovered the unit was infested with bed bugs. And get this, it had spread to the other units too. In that time, I turned over 7 of the 8 tenants, and they had to be turned over and renovated the places entirely, including the replacement of 6 AC units along with the renovation cost. All while I was on hook for the entire mortgage with not but 1 tenant. All of this drained my 250 grand savings rather quickly. So I was unemployed in a terrible job market. I'm underwater on my real estate because interest rates had risen rapidly. I had to liquidate my stock portfolio at the bottom to cover my expenses, all when my dad had gotten sick with heart problems. While I was in the middle of my own storm, life threw more curveballs my way. Once my dad was better, I couldn't afford to live in San Francisco no longer, so I moved to Austin, Texas, still Ubering, and found an entry-level job paying 52 grand while I was figuring out how to pay off 20 grand in credit card debt. All of this happened in less than 11 months. In my mind, the impossible happened. But of course, these things aren't impossible. And because I didn't have proper risk management, I was more vulnerable than I thought. And I don't want any of you to go through the fraction of that experience. I want you to know where your vulnerabilities lie. This is just an example of how I misprice risk in my life. Most people are triple long in their life, positioned that everything will go up and will continue to do so. The average person is long in their career that the job market will continue to be fruitful, to get raises, equity, and bonuses in their company, as well as promotions. They're long the stock market and the next big trend like AI or blockchain. They're long real estate with their home or rental property while being leveraged on that asset with a mortgage. Most people went to school, got a job in a high-paying role like tech, got stock options at work, and bought and overpaid for an expensive home in an expensive area. When times are good, you are good. And this strategy has returned probably 400% over the prior decade. Then here I was, the person that had aspirations to manage others' investments and failed. I was 27 and could no longer afford to live in San Francisco and moved across the country. I moved to Austin, swallowed my pride, took an entry-level job paying 50 grand, and worked to pay off that credit card debt. This experience is where I developed my risk management and investment philosophy. Today, I want to guide you through my analytical process to evaluate investments through the lens of risk by protecting ourselves against it, evaluating asymmetric risk-to-reward opportunities, and instilling the positive emotional fortitude needed to stay calm in the eye of a hurricane during a market downturn. For me to now run a large hedge fund that has public audited returns with ambitious return targets, I have to level up my game. I had to learn how to be a risk manager first and a resource allocator second. So now I view every investment with my 5-pointed shield for analyzing risk in any investment. Each point of the shield is an aspect of risk that needs to be evaluated when looked at for an investment. Each point of the shield also usually comes at the expense of the other. So you're not looking for perfection, but you're looking for balance. When all 5 points are balanced, it's known as the holy grail of portfolios. According to Ray Dalio, the holy grail of a portfolio is 8 to 12 uncorrelated investments, which together will dramatically reduce risk without sacrificing returns. Here are the 5 points: liquidity, cost of liquidity, and price quoting frequency. Liquidity means how easy it is to buy or sell something without the price changing. If something is very liquid, it's easy to buy or sell quickly because it doesn't cost that much. But if it's hard to buy or sell because it takes a long time or it costs a lot for commissions or transaction costs, then the person who owns it should get paid more for holding it. Duration. Duration means how long we keep an investment before it ends or reaches its goal. If we hold an investment for a longer time, we need to get paid more for waiting for that investment. Volatility and correlation. Volatility means how much the price goes up and down. If an investment has low volatility, it means the price does not change much, which is good for stability. If the price changes a lot, we should get paid more for the price of that going up and down in the volatile ride to get to that return for the risk. Yield and return. A yield or return is how much money we make from the investment. For example, if there is more price change, volatility, less chance of selling it quickly, a low liquidity, or a longer wait time, longer duration, we should then in turn get compensated with a higher return. Safety and use of leverage. An investment is safer to borrow money against if it is easy to sell or liquid, has a short duration, or isn't linked to any other investments, meaning it's uncorrelated or inversely correlated, and has less volatile prices. When you're looking at risk, we're looking for liquidity, duration, volatility, return, and safety of use of leverage. Let's do a quick run through of 4 examples I've provided for you of differing assets and how they compare to one another with the example of the 5-pointed shield. The first is a short 12-week US duration treasury bond. The liquidity of this is quite good. Essentially, it's the most liquid asset on earth, trading 24 hours a day, and has no transaction cost and can be instantly taken by basically everyone. It's the gold standard. Duration. You can instantly liquidate this treasury, and if the interest rate were to change, you can easily hold it to the maturity of the bond and collect that exact rate with no risk of interest change. Volatility and correlation. There's essentially no volatility on a US treasury bond, and if there is, you can hold it to maturity to get paid the interest rate in full. This is also called a flight to safety, that in times of market turbulence, there's an extreme demand for treasuries because we know that they will pay the yield. Yield and return. The yield is only about 4%, which is essentially trying to just barely beat the cost of inflation. So not super great. Safety and use of leverage. This is in fact the most liquid, least volatile, cheapest product to contract, and in short durations, they're extremely liquid with relatively low yield. This leads to the fact that it's extremely responsible and even attractive to leverage this to boost returns with other assets. A U.S. market index fund like the S&P or the QQQs. Liquidity and cost of liquidity. These are extremely liquid and can essentially be liquidated at any point for less than a penny. Duration. These investments often need 3 years to reach their average 7 to 10% return annually, but they are flexible and you can liquidate them at any moment, which helps this aspect as well. Volatility and correlation. At first glance, people may view this index as relatively volatile. However, since the price is constantly voted on every minute of each day and shows up on our brokerage screen as red and green, it's often misleading. Your probability of losing money over the course of a decade is basically zero. The benefit of an index is it's always balancing out of bad companies, buying more good companies, and vice versa, buying more new trends and selling out of old trends. The downside is it's extremely correlated to the overall money supply. So when you're doing good and it's the most common asset, often everyone else has capital as well that's chasing the same goods. The yield and return. The fact you can get 7 to 10% return with no leverage that has been a consistent over 100 years with this type of liquidity and price quoting is extremely attractive. However, it's most common asset, so it's relatively a cornerstone and not outstanding compared to most portfolios. Yield and return. The fact you can get 7 to 10% with no leverage, and this return has been consistent for over 100 years with all the liquidity and frequency of price coding is very attractive. However, it's the most common asset, so relatively it's not super outstanding because it is comparative to what everyone else is holding. Safety and use of leverage. Being it is somewhat volatile, we want to be careful with using leverage on this asset as collateral because the price of quoting can often be very irrational in the short term, and many factors outside of our control can bring the asset value down. However, the Fed will always bail out this asset in times of market distress, so in terms, it's safe to a certain extent. Private equity, liquidity and cost of liquidity. These investments are almost essentially illiquid, with prices quoted infrequently only 2 to 4 times a year. The transaction cost is very high on these assets, usually 2% of your investment each year and 20% of any of the performance. There's often also no early withdrawal ability, and it's locked up for a longer duration of time. In terms of duration, these investments are often locked up for 2 to 5 years, meaning we need to be compensated well in excess of a market return or US Treasury yield. Volatility and correlation. This is essentially an attempt to display that they have little to no volatility and are largely the product of balance sheet gymnastics. There's a misconception that there is little to no volatility on a private equity investment, but this is largely the product of balance sheet gymnastics lobbied into law. The fact that your investment is only quoted on quarterly periods and you cannot liquidate it for 2 to 5 years when it's locked up does not paint the full picture of the volatility for this. The valuations and multiples are evaluated by generally accepted industry multiples by accountants, and they generally hold assets on their books for convenient timeframes to match return targets until they can offset the loss of an asset they're holding at a different value when they have one that pays off. They also utilize debt extensively, which may not be a reflection of what could be brewing under the surface. Yield and return. This is where it gets interesting. If we are in an investment that has low liquidity, low price quoting, high transaction cost, and long duration, we must be compensated well in excess of the US Treasury or the index fund for this investment to appear attractive. This is where most people get it wrong. They don't see the red and green on the screen each day, so it's mentally easier for them to hold it. The other thing I would like to point out is that private equity investments are calculated based on an internal rate of return in lieu of a compounded annual growth rate, meaning your return is only when your capital is deployed on that investment, not necessarily when you pledge to have your capital available to the private equity firm. So if you pledge your capital in January and it's not called upon until June, if that investment were to return 7% between June and January, you had a 14% internal rate of return. However, you only gained 7% on your capital over the course of that year. Safety and use or leverage. The fact that these are liquid and do not have prices quoted on them makes them seem much more dangerous than they appear due to some great lobbying in Washington. They have some attractive terms for utilization, but you cannot usually borrow against these unless you're the private equity firm itself. A 0DT SPX risk premium portfolio investing strategy. Liquidity. The fact your investment is in cash every day at 4 p.m. and there's no lockup is quite attractive. If you exceed the market return of 10%, then it is a very attractive investment comparative to everything else because it's so liquid. Duration. These investments are constantly quoted every millisecond of the day and are in cash each day. So there's a very short duration to realize return and have proven consistent over any 90-day period since inception in 2016. Volatility and correlation. It is very easy to define your size and the volatility of risk you would like to take day to day with 0DT. Some will say that you're picking up pennies in front of a steamroller, but not having risk to any events outside of market hours is very beneficial, which is 80% of all hours in the weeks. This provides you very many options, as well as extremely uncorrelated to many market events, and also returns positively during most tail events and large sell-offs. Yield and return. The yield and return is far in excess of many investments, and we have a high confidence in the return because it is in cash every single day and creates a large amount of occurrences to realize the long run over a shorter term period. So anything in excess of index returns is quite good. There's also no multiple assigned to this, so your investment is free from any type of sentiment or money supply within the market and unaffected by interest rates. Safety and use of leverage. This is again largely up for debate, but the fact that there are risk-defined spreads makes it completely easy to define your risk and therefore enables you to leverage responsibly, like if you would like to leverage a treasury yield. Now that we understand risk management as it pertains to specific investments, I'll show you what risk managed investments look like. I want you all to leave today that there's a program with an understanding of how to manage your biggest risk, yourself. We all know that technology has made investing 1,000 times easier, and in many cases, much more effective. Multi-billion-dollar firms are using AI and algorithms for years, and now today, the average person can utilize AI and algorithms to help themselves. I'm highlighting this because technology and algorithms have made it very easy to fall into the false belief that investing is much more logical now. But you cannot remove the human element, yourself, from your investing decisions, meaning your emotions will always be a factor in your investments, which means you also need a game plan for dealing with them just as much as you need a game plan for risk management. Which brings us to your A game, B game, and C game. This is fitting because we deal with probabilities in trading. We also have a bell curve of our emotions that make up our A game, B game, and C game. These levels of our emotion are a given and appear just like probabilities in your trading, and you will experience them, all of them, in equal amounts. It is paramount that you focus on elevating each part of that bell curve, the A game, B game, and C game, along the line. Your A game. In anything we do, we all have our A game, B game, and C game. The A game is what we strive for. Your A game is when you're in flow, you're sharp, you're confident, you're not impulsive, and you're intentional. Can you make a mistake in your A game? Of course, but A game mistakes come from lack of knowledge or a pattern that is yet to be identified. And then you learn from those mistakes and move on and get better. Your B game is your average. You might not be firing on all cylinders, but you're doing fine. You have the presence of mind, mental energy, and emotional control to avoid impulsive decisions. Then there's your C game. Your C game is your emotions. You have an impulse and you act on it. You can't stop yourself from forcing it or getting out too early. Your C game is volatile. It's also important that your C game rarely looks like a slump. It's not like a batter who keeps striking out for several games. No, your C game pops up quickly. It trips you up and it's gone. And the damage is already done. The C game is a mistake that is so obviously wrong that the second you do it, you know it was wrong and you'd made a mistake, but you couldn't control yourself. Now let me ask you, of these three types of game, which one do you think is guaranteed? You guessed it, it's your C game. You can't get rid of your C game. You can only improve it. But before we dive into ways you can improve your C game, I first want to show you exactly what risk-managed A game actually looks like. Then I'll show you how the A game performed during some of the worst market days in the past few years. Now, I'd like to share with you two things. First, I'm going to pull back the curtains on one of my A-game strategies. This is the technical part of the program. If you like nerding out on this stuff, then buckle up. It is a bit jargony for anyone else out there, but don't worry, I won't stay here too long. I share the A-game strategy simply to show you what it could look like when someone is performing at the peak of their game. Then I'll share with you exactly how my C-game slipped in during those adverse market conditions and created a mistake which led to a big learning moment for me, but also followed by a bit of relief. First, non-negotiable. Non-negotiable number one. If you have any chance of blowing up, even if it's 0.00001% chance, then you have no edge and the strategy is untradeable. Now, if you don't speak trader jargon and your eyes glazed over for a second, don't worry. Let me translate this for you. I've learned that blowing up can be confusing for many people because in other words like music or YouTube, blowing up could be a good thing. If your track blows up or if you blow up on YouTube, then you're a success and you may be crushing it. But in finance, if you blow up, then things are in shambles. Blowing up means you risk too much, which is why if there's even the tiniest chance that your strategy could lead to catastrophic losses, no matter how rare, it means that your risk is really not under control. And just in case you're wondering what edge is, edge means your return is in excess of the expected return of the market. So if a strategy seemingly has high edge, it has a positive expected value. But in order to gain that edge, you're risking damn near everything, then there is no real edge and you don't trade it. If we define edge more simply, I believe it has two parts. One, being able to form a more accurate price in the marketplace. Two, being able to protect and mitigate risk so that you can create enough occurrences over a long enough period of time to realize that edge in terms of profits and P&L. This is the predominant focus of non-negotiables and guardrails that we'll discuss below. Non-negotiable number two, hedging is not something that you do after the fact, like putting on your seatbelt once a car starts skidding. True hedging happens when you place the trade. It's a proactive move, not a reactive one. You must enter the protective position, long and short, at the same time you are entering the position you are safeguarding. This keeps your exposure balanced from the start as you are selling and buying the same price volatility. Non-negotiable number three, our stop loss is our first line of defense. We use them as our hedge, and it's formulated so that we don't actually need them. Stop losses will help us improve our Sharpe and our ability to profit at predictable inflection points of risk and reward in the times of normal market conditions. But a stop loss is no way to hedge against real risk, and we must allocate a portion of our profits to pay for hedges to protect us against black swan events that have never occurred, and these hedges may very well never pay off, but they're worth every penny. Non-negotiable number four, always use a vertical spread, even synthetic ones, to clearly define potential losses and generate consistency during normal market conditions. I recommend using a max of about 40% of your buying power. A well-positioned options portfolio should provide uncorrelated returns with a Sharpe over 2 while profiting from convex moves of over 3 standard deviations. This also defines our max loss absolutely and gives us certainty that we do not have to depend on the skew or volatility scaling linearly across different durations. We have defined our capital requirements for the trade and our delta exposure, which allows us to be able to hold positions until liquidity returns to the market or hold until expiration in the event when the exchange shuts down. No broker or market can force us to liquidate our position before we see fit. There are a lot of irresponsible, over-leveraged participants in the marketplace that when something blows up, a cascading margin call spikes across the volatility of the market, spiking the bid-ask spread to irrational prices. I do not want to be the one exposed to short-term inaccurate pricing from others' ability to fail to manage risk. Non-negotiable number 5, we must always be net long units of option contracts for the same instrument and same duration. So if the exchange were to go limit down minus 20% and the exchange shut down, you would be guaranteed to profit from the long side on that down move. Guardrails. The following were the non-negotiables of my A-game strategies. These are the guardrails of my A-game strategy. Guardrail number 1. During black swan moves of over 3 standard deviations plus, the portfolio must always be positioned as net long option contracts of the same duration, net long all Greeks, which include gamma, vega, and delta. What I like to say is life is long gamma, so should your portfolio. Guardrail number 2, vega is fake, gamma and delta are real. Hedge accordingly. The short-term spikes in volatility are pricing in future moves based on the aggregate demand in the market. Have your hedges protect you from spikes in vega and carry more long vega in your hedges than in your credit trades. The way I like to describe this is to be locally concave for income with your credit trades and globally convex for hedges with your debit trades. We must profit from the fear of vega and don't have exposure to it in our credit trades. Here are some of the vehicles I use for hedging. Number 1, direct puts in the S&P complex. It is crucial to have direct offset for your exposure. While the concept of tail risk hedging is well understood, the risk of execution is often overlooked. Certain exchange-traded products like VVIX or TVIX may not perform as anticipated, with markets experiencing halts and exchange temporarily shutting down during times of high volatility. Having an inverse correlation to the asset you are protecting against is a must. Number 2, calls in the VIX complex. The VIX serves as a proxy for variance and convexity, representing volatility squared to a significant degree. Despite the market's forward pricing skew, exposure in this complex performs exceptionally well during market stress, accelerating return amidst turmoil. 3, puts in low volatility ETFs. Derivatives on assets with minimal volatility are essential. We are hedging with the assumption that when tail events occur, all correlations are approaching 1. Assets with near zero volatility priced in are an ideal target. Historical data shows that repricing in low beta assets, even if the underlying assets don't suffer significantly, can yield substantial returns during market crashes. Think TLT in 2021 with a 25 basis point interest rate when a 1% move was priced in at mere pennies. Number 4, dynamic monitoring. Continuous asset monitoring and adjustment to the exposure of these assets is vital to protect your capital in these evolving market conditions, as well as monetizing on moves. A good rule of thumb is to build in some trade with profit takes and other trades that are always held to expiration. A VIX handle of 45 to 60 is often a very good flag for monetization of these hedges. Lastly, I want you to remember that your worst drawdown is in front of you. I guarantee it. Plan, test, and model your assumptions accordingly. The models. All portfolios start with risk management first. When we start with a long vol debit trade that has a positive expected value, it is literally pure gold. Because we now know how to protect against this risk, we can formulate a credit trade that best matches the risk protection that is provided. This hedge is completely systematic, meaning it was placed every single day for over 1,000 days within this period from 2020 to 2024. This includes when the VIX was 80 during COVID, the Friday before it was known if SVB was getting bailed out during the banking crisis, and the day Russia took over the nuclear power plant in Ukraine in 2022, and many more events. The main key here is that the mechanical long vol suite has a positive expected value. There is no signal for this whatsoever. We are just taking advantage of the fact that longer dated options hold more vega and less theta than shorter dated options, while balancing that against the delta exposure of our short options. This is the credit part of the hedge that finances the cost of long vol during suppressed volatility regimes. These are inversely correlated by minus 0.27 to the long suite to this one, and are also entered every single day at the exact same time. It is entered at the same time as the long vol suite, being we are buying and selling the exact same volatility. Therefore, when it moves, the hedge behaves as anticipated. Now we have a portfolio that is very capital efficient, providing margin offset from the long vol suite to the short vol suite. The buying power is defined and only uses about 20% of our capital. Yet this yields twice the average market return of the stock market, with 1/3 of the volatility, or a beta of 0.3, and only a correlation of 0.4 to the S&P. The P&L graph. Now, I know everyone out there will say past performance is not indicative of future returns, so let's model what occurred in the black swan case scenario. What is a black swan, you say? A black swan is an event that's always possible, but you don't think it was possible because your opinion was only based on things that have happened in the past. You think all swans are white because you've only seen white swans, when in reality, a swan could be any color. And when you see one that is black, you realize that it's possible. The graph above shows the P&L in regards to risk modeling. The middle orange line is the current spot price of SPX. Each line to the right then shows minus 20%, minus 10%, up 10%, up 20%, and an overnight move. The colored line indicates the VIX levels. Pink is the current spot of VIX. Yellow is an 80 VIX handle. The rest of the lines are steps in between. Gamma. As you can see here, gamma, we are short in the belly. Interesting, it goes long gamma at the shoulders, then flattens out at the far tails. Delta. We are initially long delta in a drop, then it flattens to zero. Conversely, we are short delta on a pop, and then it flattens to zero. Vega. We are in fact long vega. A sudden spike produces a large spike in P&L, and notice that the lines basically plateau to zero at the extreme tails. Now let's see how this actually behaved during the largest volatility event in history, August 5th, 2024, otherwise known as VIX Sella, or the unwinding of the yen carry trade. It was the craziest market move in over 40 years. For context, the VIX, or otherwise known as the fear index, a number that shows how scared or fearful the market is, went from 23 to 65. An average VIX is only 17, and on August 5th, it was 65. This kind of move has never occurred before, and statistically is expected to occur once in a lifetime, or roughly once in every 59 years. I did my research, I made my plan, I was ready. The market was about to go down a lot before the open. We were marking out a 65 VIX handle and approaching a -7 limit down move before the open. Thanks to my A-game strategy, I was up 2% on my account, but my positions went far beyond my stop loss, so I had to manually walk down the positions on my brokerage account manually. When the market opened, I started to shell my shorts first, then I sold my long options. And in just that 2 minutes it took to manually close out my longs and then my shorts, I went from being up 2% to down 1%. I was nervous and made a mistake. I was supposed to sell my long options first. Since I was marking positive, my risk was to the upside, not the downside. My brain told me to close out my long options first to lock in the profit. But my emotions pushed me off track and told me to protect myself against my risk and close out my short options first. That was my C game. Now, because my A game was still supporting me, my actual loss was 1/5 of what happened to the rest of the market. Remember those models that we looked at? Well, the impossible happened. VIX went to 65, market was down over 5%, and I was 3 times leveraged notional the value of SPX. I had 25 SPX short puts that I took on that Friday afternoon, 3 days to expiration, right before the market took its biggest dump, amounting to near $15 million in notional exposure. Let's unpack how these hedges worked. I lost about 200 grand on short put options, 160 grand of which was to Delta exposure and 40 grand of which was to Vega expansion. I lost 22 grand on my long calls for a total of minus $225,000. I profited on my hedges, $115,000 from Vega expansion and $100,000 from Delta expansion for a total of 225 grand. Then I lost 25 grand walking down my orders and closing out my short before closing out my long. By the way, this also works on upside days of more than 3 standard deviations. For an example, here's election day, in which we had a close to 3 standard deviation move up and moved them more than 3% in the SPS index. And I was over 4 times leveraged on calls and returned over 3% that day. The Fed day, February 18th, happened relatively recently. In seemingly about 2 hours, we went from slightly positive to down 3%. I'm sure you all remember this. I ended up being up 2% on the day. So intraday moves, overnight moves, during the week, during the weekend, and upside moves, this all worked. Now, I want you to know that risk management is a process. You have your non-negotiables and you have your guardrails. Now you've not only seen what an A-game strategy looks like, but you've also seen how A-game strategies can perform during terrible market events, even if your C-game does slip in. I'd like to leave you with my overreaching philosophy on how you as an investor can manage your biggest risk, which we've already discussed is yourself. I call it the inchworm. Basically, you might recognize the shape of this. It's a bell curve, and it looks a lot like your A game, B game, and C game. Here's why I choose inchworm. Basically, what the inchworm does is it straightens out, grasping a leaf with its teeth, then pulls itself back and forward with its leg, forming the shape of a bell curve similar to your A game, B game, and C game. This anchors itself with those back legs so it can then again reach forward and keep progressing. So if we translate this to our A game, B game, C game bell curve, we can learn that our C game is what anchors our A game, which means that the best, most fundamental way to improve your A game is actually by improving your C game. And what do we know about our C game? The riskiest part of us, it's emotional, it's impulsive, it's irrational. You can think of it in this way. Your A game is your technical edge, your C game is your behavioral edge, and your B game is the average of the two. Fail to address and manage your C game and everything else will be tethered back. You will only accelerate to the level your C game will allow. But when you pull your C game up, you then establish an entirely new bell curve for yourself and your profits. So let me share with you ways you can protect yourself from your C game. The most common form of C game is what I call being cute. This looks like chasing a shiny object, the girl in the red dress, and trying a new strategy every day, or posting your P&L on Discord, or curve fitting a backtest to be a Discord backtest hero. I used to post my results daily and realized that I was acting in a way with my body and my mindset that daily returns mattered to a community of people that were not going after the same thing I was. I realized that by doing this, I was going against my data-driven approach to realize quarterly return targets, so I now only share results on monthly and quarterly periods. So one of my daily mantras that I like to push on this is don't be cute, just execute. The second thing you need to protect against is stressing over unrealized gains. A lot of traders out there will get depressed over the fact that midday they saw they were marking up 40% on their position and they thought about closing it and they only ended up 10% at the end of the day. Unrealized gains are irrelevant in relation to actual P&L. So eliminate the feeling that at the end of day, if you didn't optimally close out your position at the exact time, it was a failure. I often get asked by a lot of people who ask me, how do I do it? How am I not a nervous wreck all the time and managing this much in zero DT? I start to chat with them and ask them how they feel when they're trading. They will often tell me what needs to happen for them to feel good. And the key factor here is their wording. They will often say they need to be constantly adapting to market conditions and they need to make money every day. And every new strategy that they put in makes money, and that they had a great day and had a perfect amount of sleep and they picked the new trend and they adapted quickly. Then I'll ask them what makes them feel bad. And they will say that they're late to adapt to a market regime, they didn't make money, they didn't close out the position that quickly, or this happened, or this happened. And you can, if you pay very close attention to what's occurring here, is their language and how they define to feel good. When they feel good, they have to have this happen, and happen, and happen. And they have all these rules for exactly what needs to happen for them to feel a certain way. Then I ask them what makes them feel bad, and what they say is, this needs to happen, or this needs to happen, or I'll lose money. And you see there that a multitude of things can happen. Not everything falls in line perfectly for them to feel bad. And after listening to them, I had a realization of myself is that I have more ways to feel bad than I have ways to feel good. So I rewrote my rules on what had to happen, programmed my mind correctly, which allowed me to adapt to the market, feel better every day, and continually improve. The third mistake is manually trading. If you're manually trading and not automating, you're just opening yourself up to mistakes because you're constantly at the wheel of the brokerage firm to potentially make a mistake. I noticed that this made me tense while I was at the computer, and I had to use willpower to emotionally not act, which also took away from willpower that I could be using to elevate my A game. Brokerage firms are made to keep you engaged and continue to trade. That's why they have red and green lights, just like a casino. And perhaps also the sneakiest way of this is negative language. When I first started trading, I was never really stressed. It wasn't until I started to run a fund that I felt extremely stressed, to the point where I would throw up at the end of mini market days because I was freaked out. It took me a while to figure out what the shift was. Things changed after I started running a fund, and I asked myself, why did I never feel stressed before? Then I realized when I would tell people what I did, I said, I run a hedge fund, and they would always respond without a shadow of a doubt, oh, wow, that must be really stressful. And I would always agree with them, say, yeah, it is stressful to feel important, like I was doing something big. And yes, that was it. The seed of negative language took root in my mind. So to weed that out over time, anytime someone would say, oh, that's stressful, I would correct them and simply say, I love what I do and I enjoy the responsibility. And lo and behold, my stress levels significantly decreased and eventually withdrew completely. Think of someone that describes themselves as a workaholic versus they love what they do. They can work the exact same amount, perform the exact same tasks, but yet how they describe themselves completely changes their experience between they're addicted to work or they love what they do. Now, that's just one example of negative language. And of course, you can't control what others say, but you can always control what words you embrace and what words you say to yourself. So those are the things I want you to use to protect yourself against those negative emotions. I'd also like to offer you a few things that I include in my Inchworm toolkit to help you protect yourself from those common C game mistakes. The first one up here is what I call the Backtest Serenity Prayer, which is a play on the Serenity Prayer, which I'm sure a lot of you have heard. And it's, God, please grant me the serenity to accept the things I cannot change, the courage to change things I can, and the wisdom to know the difference. The next thing I do here is at the end of each trading day, I do this after action report answering these three questions. What went well today? What can I improve on tomorrow? And what did not go well today? I always state all of these questions with a 6-to-1 ratio of statements in the positive fact. Like, I learned this today by making a correction to my software, or I noticed this cool way of how I could improve on my trading tomorrow. And by doing that, we keep the energy in our human mind that we get that additional affirmation and can improve more day to day. Third, and this is probably the easiest one for all of you, I grayscale all of my brokerage screens. All of them are designed to create engagement and even excitement with flashing red and green lights, kicking off your dopamine response and fight or flight response. Changing the screen to black and white significantly minimizes emotional decisions and greatly improves my executive decision making. So here's what I want to leave you with. Risk management is not just a strategy for investing, it's a mindset. It's a commitment to yourself, your portfolio, and your future. It's about choosing certainty over chance and control over chaos. We started this video by acknowledging that risk is unavoidable, but the good news is with the right tools, processes, and mindset, it's manageable. You can walk into every trade, every investment decision with clarity, confidence, knowing exactly what stake you have and how to respond to it. The market will always have twists and turns and change, and life will always throw unexpected curveballs. But when you embrace risk management as your foundation, you don't just survive those moments, you thrive in them. Remember, you don't need to predict the future to protect your portfolio. You just need a process, and that process is what separates successful investors from the rest. So as you close this video and return to your trading desk and your investment plan, I challenge you to ask yourself, do I truly know my risk? Am I managing it like I should? Because if you don't know your risk, you don't know your investment. But if you do, and you take all the steps I've shared with you today, you not only will be a better investor, but you'll also have the peace of mind to enjoy the rewards of your hard work. For everyone that made it thus far, thank you for sharing your time with me. If you have found value in this, it is the highest compliment to me if you would share it with 5 other people you think would find value in watching it. This is the culmination of what I have learned up until this point. Please reach out to me if you have any ideas on how to improve this risk management framework, or if you have any ideas or things you would like to discuss in regards to additional parts to add to this framework. In service, 0-day mark. Also, I'd like to thank everyone and some inspiration that I got from this speech. So I'll link names down in the description. I'd like to thank Chris Seidel, Jared Tenlander in his book, everyone on Discord that added to me and have talked to me over the period of time, Tony Robbins, who's been a big inspiration and impact in my life, as well as David Sun, who originally, kind of gave me some advice and showed me what systematic option trading is done like at its highest ability. Thank all of you and anyone else that I forgot to, thank. appreciate it to the highest degree.